Have you seen the headlines about the Indian Rupee hitting record lows against the US dollar? It's a huge story, and it's not just some abstract number for traders. It's a story about massive global forces, tricky national economics, and, believe it or not, it has a direct impact on your wallet. So today, let's unpack exactly what's going on, why it's happening, and what it all means. Take a look at this number, 88.6. Back in September 2022, this is how many rupees it took to buy a single US dollar. This was an all-time low, and it sent alarm bells ringing. Now, why does this one number matter so much? Well, think about it. Almost everything India buys from the rest of the world, the crude oil for our cars, the chips in our phones, it's all paid for in dollars. So when this number goes up, the cost of pretty much everything goes up with it. It's a shockwave that you feel across the entire economy.
And that really gets us to the heart of the matter. Why is this happening? Is the Indian economy in some kind of trouble, or is this just part of a much bigger global picture? And the most important question of all, how does the value of the rupee on a foreign exchange market actually change things for you, for your savings, and for your future plans? We're going to get into all of it.
All right, here's how we're going to break it all down. First, we'll get some historical context. Then, we'll dig into the major forces that are pushing the rupee down. After that, we'll look at who actually wins and who loses in this situation. We'll also meet the key players trying to manage this whole thing. And finally, we'll talk about what the path forward might look like.
Okay, Section 1, Rupee hits all-time lows. To really get a grip on why today's numbers are such a big deal, we need to rewind the clock a little bit and see where we've come from.
You see, this recent slide isn't some random event that came out of nowhere. It's actually the latest chapter in a long, long story. Right after independence in 1947, a US dollar cost about 3.3 rupees. Can you believe that? Jumped to 1991 during the big economic reforms, and it was almost 23. By 2018, it had blown past the 70 rupee mark, and as we saw, it went beyond 88 in 2022. So yeah, the long-term trend is pretty clear, but it's the speed of this recent fall that has everyone so concerned.
Okay, just a real quick sidebar here, but this is super important. You'll hear two words thrown around, depreciation and devaluation. They sound similar, but they're totally different. What's happening to the rupee right now is depreciation. It's falling naturally because of market supply and demand. Devaluation is when a government intentionally pushes the value of its currency down, usually to make its exports cheaper. So remember, what we're talking about today is all about the market.
So what exactly are these market forces we're talking about? The rupee isn't just falling on its own. There's some powerful currents, both inside India and around the world, that are pulling it down. Let's get into the three big ones.
All right, the first major cause, and you could argue it's the biggest one, coming from inside the country, is something called the trade deficit. It's a core economic idea, but it has a very direct, very powerful effect on the rupee. So what is a trade deficit? It's actually pretty simple. It means India, as a country, is spending more money buying stuff from other countries, imports, than it's earning by selling its own stuff abroad, its exports. Think of it like your own household budget. If you're spending more each month than you're earning, you've got a deficit. When a whole country does that, it puts serious pressure on its currency. And here's how that plays out. To pay for things like oil or electronics, Indian companies need US dollars. So what do? They go to the market, sell rupees, and buy dollars. Now, when the whole country is constantly buying more than it's selling, you get this huge, relentless demand for dollars and a massive supply of rupees just sitting there. It's basic economics 101. When demand for something is high, like the dollar, its price goes up. And when supply of something is high, like the rupee, its price or value goes down.
The second big driver is something called capital outflows. Now, this isn't about physical goods. This is all about money, big money. It's about where global investors choose to put their cash, and when they decide to pull it out, it can feel like a tidal wave hitting the shore.
So you might be asking, why would anyone pull money out of a growing economy like India? Well, it really comes down to two things: fear and greed. When things get shaky around the world, like a major conflict or fears of a global recession, investors get nervous. They pull their money out of what they see as riskier markets and run for safety. And the ultimate safe haven asset is the US dollar. That's the fear part. The greed part is about interest rates. When the US central bank raises its rates, investors can suddenly get a better, safer return on their money just by parking it in the US. That's a huge magnet for money, pulling it out of countries like India and, you guessed it, putting more downward pressure on the rupee. And that leads us perfectly into our third major cause. Because you see, this isn't just a story about a weak rupee. It's just as much a story about a really, really strong US dollar. They are two sides of the same coin. You have to remember, the US dollar is the world's main currency. So in any crisis, everybody, investors, companies, even other countries, rushes to buy dollars, which pushes its value way up. That's that safe haven effect we just talked about. Add to that the fact that the US Federal Reserve has been aggressively hiking interest rates to fight its own inflation, which makes holding dollars even more profitable. The main takeaway here is that the dollar has been flexing its muscles against almost every other currency out there. The euro, the British pound, the Japanese yen. The rupee is just caught in the same storm.
And if those three big factors weren't enough, you've got this perfect storm of other pressures. High oil prices are a huge deal for India, which imports most of its oil. A bigger oil bill means we need more dollars to pay for it. Then you have inflation. If prices are rising faster in India than in other countries, the rupee's buying power slowly erodes. And finally, those interest rate differences we mentioned. If you can get a better return elsewhere, the money is going to flow out. All of these things are pushing in the exact same direction, down.
Okay, so we've talked a lot about the why. Now it's time for the so what, because a falling rupee isn't just some headline. It has very real, tangible consequences, and it creates a very clear set of winners and losers, both in the big picture economy and in our everyday lives.
Let's start with the winners. Exporters absolutely love a weak rupee. If you're an IT company billing clients in dollars, you suddenly earn more rupees for the exact same work. Same goes for textile or pharma exporters. Their products get cheaper and more competitive globally. And families who get money sent from relatives working abroad also win because their dollars or pounds convert into more rupees back home. But there's a big list of losers too. Anyone importing goods from oil companies to electronics sellers sees their costs go up. If you're a student planning to study overseas, your tuition and living costs just got a lot more expensive. And ultimately, every single consumer feels the pain through higher prices.
And these effects don't happen in isolation. They create a chain reaction that ripples through the whole economy. A weak rupee directly causes something called imported inflation. Basically, the cost of all imported stuff goes up. This makes that trade imbalance, the current account deficit, even wider. For any Indian company or even the government that has borrowed money in dollars, their debt just got bigger in rupee terms. And when you put all that together, it can really put the brakes on the country's overall economic growth.
And this is really where it hits home. Imported inflation isn't just some jargon. It's the reason the price you pay at the petrol pump goes up. It's why that new smartphone costs more, even if it was assembled in India, because all the little parts inside were paid for in dollars. A weaker rupee, sooner or later, always means higher prices for everyone.
So that brings up a really important question. With all these massive forces pushing the rupee down, is it just helpless? Is it totally at the mercy of the market? Well, not exactly. There are some very powerful players who can step in and pull the levers to try and manage the situation.
The number one player, the one who steps into the ring when things get chaotic, is India's central bank, the Reserve Bank of India, or the RBI. You can think of the RBI as the official guardian of the rupee, and it has a pretty powerful toolkit to defend it.
And this number gives you an idea of just how much firepower the RBI has. Over the years, India has built up a massive war chest of foreign currency reserves, at one point touching almost $700 billion. These reserves, mostly held in US dollars, are the RBI's main weapon for stepping into the market to support the rupee.
So how does this actually work? Well, when the rupee is falling too fast and it looks like panic is setting in, the RBI jumps in. It starts selling some of its US dollars from that giant reserve pile. What does that do? It instantly increases the supply of dollars in the market, which helps to soak up all that high demand. Now, the goal isn't to force the rupee to a specific number, but to act like a giant shock absorber to stop a free fall and bring some stability back to the market. But, the RBI isn't playing this game alone. The government of India's policies on trade and spending have a huge long-term effect. The decisions of millions of international investors and other central banks, especially the US Fed, can sometimes be so powerful they overwhelm what the RBI is trying to do. And of course, at the end of the day, it's the daily buying and selling by importers and exporters that creates the basic supply and demand in the first place.
All of which leads us to our last and probably most important question. So, what's the way forward? With all these complex moving parts, what can actually be done to build real, long-term strength and stability for the Indian rupee?
Well, there's no single magic bullet here. The real answer lies in a long-term strategy that focuses on the fundamentals of the economy. Really, the goal is simple. Earn more dollars and need fewer dollars. You earn more by making your exports stronger and more diverse. You need fewer by reducing how much you import, especially oil, by pushing things like Make in India and renewable energy. And the other big piece of the puzzle is making India a great place for stable, long-term investment, not just for money that's going to flee at the first sign of trouble.
But this is all a very tricky balancing act. It's like walking a tightrope. For example, the RBI could jack up interest rates to attract foreign money and boost the rupee. But that would make it more expensive for businesses and people to take out loans here in India, which could slow down the whole economy. Every decision has a consequence, a trade-off, and that constant, delicate dance between growth, inflation, and the currency is the real challenge for policymakers.
And that kind of leaves us with one final big question to think about. We always see a weak currency as a bad thing, right? A sign of weakness? But could it also be a catalyst for change? Is it possible that the pain of a weaker rupee is the very thing that forces the country to make those tough but necessary long-term changes in trade, manufacturing, and energy, the kinds of changes that could build a stronger, more resilient economy for decades to come?
The story of the rupee is definitely not over. It's changing all the time. If you want to dig a little deeper into everything we've covered today, you should head over to our website. We've got detailed notes and a handy mind map to help you revise the key points. The link for that is right down there in the description. Thanks so much for joining us.